Every funding round changes your company materially. And most founders do not realize this or see it coming until it's too late. Harlem Capital manages over $230 plus million, and we have invested in over 70 plus companies. And some of those founders of companies we've invested in twice, sometimes 3 times. And so I want to tell you this story of all the things that they wish they knew the first time around when they were fundraising capital for their company. And so I just want to be able to break down and help you out with each level and each stage of funding rounds and specifically give you the inside look of what the expectations of an investor are and also with the size of the round and the valuation. Let's start with the first round of funding. The first round of funding is typically family and friends, or known as the pre-seed round. This is when you are at the idea stage. Like you don't have any code written, you don't have any product. It's just you, a few founding team members, and an idea. The family and friends who are going to invest may not actually be family, but they'll most likely be friends, colleagues, bosses, people that you have worked with in the past. And most of those folks are going to write angel checks. I'm talking 5,000, 10,000, maybe 25. And if you're really lucky, you can get an angel to write 100 plus K. Now, in terms of the size of the round, it's anywhere between 500,000 to $2 million round. Yes, pre-seed rounds have gone way up over the last 2 or 3 years. Let's talk about the type of dilution you're going to take in this round and the valuation. The type of dilution is going to be 10 to 20% dilution. And then the valuation is probably going to be anywhere between $5 to $10 million. So realistically, you can expect for someone to give you an offer or for you to raise a round of anywhere between $1 to $2 million on a $5 to $10 million post-money valuation. And just in case folks aren't familiar with post-money valuation, that is typically the valuation of the company post giving you capital. And everything that I'm talking about right now for pre-seed should be done on a safe. You don't want to spend time, money, or lawyers on something that is pre-product, pre-idea, and just very prototype stage. We can save the term sheet and the price rounds for later. And at this stage, realistically, no one is investing in the business. Everyone is actually investing in who you are or the idea. So you have either a prepared mind investor who already has been interested in this industry, or you have someone you've already known or worked with in the past who really values your ability to execute or your expertise before starting the company. There is one caveat to the pre-seed and angel round. Many people like to do accelerators like Y Combinator or Neo or other types of accelerators. If you're going to do those, you should expect to receive a few $100,000 and give up roughly 7% of your business. That means that when you actually go fundraise for what we're about to talk about next, the seed round, you're going to have a much higher valuation because you've given up more equity on the front end. But typically, you give up that 7% equity because those accelerators are going to do exactly what they say. They're going to accelerate you. They're going to put you in a group of people in a cohort to compete against and to get better from. They're going to bring in people who can network and mentor you. And then lastly, they're supposed to introduce you to investors. And so their value for doing that is the 7% equity. See how the story unfolds. Secrets in silence more precious than gold. All right. Okay, it's time to talk about the seed round now. The seed round, the capital for that round is typically used to find product market fit. So at this stage of the business, you have your founding team, you have your early hires, and you now have a product. And then lastly, you have some early customers. Your job is to pivot and evolve and move to find a product that can be pulled and asked and wanted by customers. And not only will they want to buy this, they will buy it at any price because the pain point that you are solving is so important that they will actually buy from an unproven team that has only been a company that's been around for less than 1 year, and people who literally potentially are half their age, right? That's how big the pain point is. And so at the seed round, you are typically fully focused on figuring out how can you find product market fit, which is essentially when you sell a service at a fair price and everyone in that market continues to buy it. That is product market fit. An example can be Walmart. When you go to Walmart, you buy something. When Pepsi launches a product, you buy it. When Nike launches a new product, you buy it because they know their market so well that when they put out any product, people buy it. Okay, let's look at the snapshot here. So typically you can think about raising $2 to $5 million. That is the size of the round. In terms of dilution, you can think about having 15 to 20% dilution. And in terms of valuation, you can think about a $15 to $25 million post. Now, the seed round and these later rounds are when competitive pressures from other investors and other offers can drive up prices. So just because I'm saying you can expect $15 to $20 million post money valuation doesn't mean that if you have 3 to 4 term sheets that you can't get a valuation that's at 30, 35, or $40 million posts. To round out the seed round, this is where you have seed investors. So people who write anywhere between $1.5 million to $5 million checks into rounds. They are now going to be investing in the business instead of the last round when they were investing in the founding team members and the vision. Now people are starting to look at the metrics of the business. And this round should also still be on a safe. A safe is future equity. We do not need to spend a ton of money on lawyers building out all the legal documents for this round. But you have to be careful here. Anytime you are focused on valuation over partner or relationship, you can get into very murky territory. I always suggest that founders focus on the partner, especially early in the game. You're going to be married to this person for the next 10 years. You want to be married to people and be in a relationship with people who have very aligned values and focus points and agreements. If this just becomes a transaction for them and you just take the highest bidder, bad things can happen in the future.
Let's go. Let's go. Ice, ice. Yeah. Stack it up. Yo. Watch the money pile.
All right, now it's time for the Series A round. The Series A round is when you are starting to show true signs of product market fit. From a revenue standpoint, I would say you're at probably $2.5, $3 million of revenue, if not more. You're at least growing 3 to 5x from your previous year. And you have a full team. So you have customers, you have a product, you have a full team, you're looking to hire more people, and you are starting to prove that customers really love your product. For this round, you can raise anywhere between $10 to $30 million. This is going to be the first time that you really bring in lawyers, and you're going to have what's called a priced round. A priced round is literally when you have a specific firm price. This is not a safe for future equity. This is a firm price, and you are going to spend money building out the entire legal backbone of the business. Now, diligence for this round will be a lot more intense than the pre-seed and the seed. An investor may spend 30, 45 days digging deeper into your company. They're going to want to see all your financials. They're going to want to speak to 5, 10 plus customers. They're going to want to do a ton of references. But this is the first time where a big institutional fund who's going to write 10, 20 plus million dollars to your company. And this is where everything is actually becoming a transaction from now on. This is not going to be a lovey-dovey relationship. As soon as they invest in a business, they want to, in a very short period of time, start to see traction and returns on their capital. Last piece is here. This is when you have a term sheet. A term sheet is a sheet of terms that are typically around governance, which could be information rights, pro rata rights, which is like, do I have the right to invest in the next round to make sure that I keep my ownership from the last round? And major investor rights. These are specific rights that only major investors get. You might have a board now after you raise your Series A, which is people who help govern the business. They can veto things. You have to get their approval on things. So this is really when the business starts working. You probably have an office where everyone's in person, and you have all these new things that you now have to manage. You now have to go from individual contributor to manager and CEO. So go from founder to CEO. All right, folks, we're now going to raise our Series B. When you raise a Series B, this is time to scale the machine. So you have now figured out product market fit. And now that you have a service and product that people really want to buy, your job now is to find every single person in the market who can buy it and win them over. So you're now about to raise a massive round. You can raise anywhere between 25 to probably $75 million for this round. You're going to go full throttle. You're going to open up more offices. You're going to hire a sales team. You're going to start hiring executives. And your revenue is growing strongly. You're in between anywhere between $5 million of revenue and maybe $20 million of revenue. And your job is to still continue to grow 3 to 5x year over year. And all the capital you're about to fundraise in this round is literally going towards growth and go to market. Now, I do want to talk about the mindset here. We are no longer a scrappy startup. We are becoming a corporation. We have rules. We have human resources. We have a chief legal counsel. We have all these things that are now being put into place to grow as a company, to become a corporation. So we are putting on our big boy and big girl pants. All right, in terms of round size here for the Series B, typically I would say 25 to 50, but you can, in some occasions, get up to a $75 million fundraise amount. Now that equates to a valuation anywhere between about $150 million to $300 million valuation. And this is no longer early stage VCs. You are now working with growth investors. These are folks who write big checks, who not only take board seats, they might take 2 board seats. They want to give you a coach. They want to give you all types of mentors. They want to be working out of your office at times. This is a very serious part of the business, and people are going to really lean in. And the diligence process is going to be very similar to Series A, 30, 45 days. You will still have a price round. And every time you bring on a new investor, you're most likely now bringing on a new board member. Now let's talk about the Series C. The Series C is where we're now going to focus on market leadership. We have now figured out a product and tool that people want to buy. That was a Series A. Series B, we're starting to scale that machine. And then now with your Series C, you're probably thinking about expanding to new product verticals and new features. Also at the Series C, you're focusing on marketing, branding, thought leadership. You're expanding geographies. Like you really want to kind of like dial in the brand. What is the thing that people say about your company, about your employees when they're not in a room? That is going to take a lot of like money, psychology, and also new investors. This round is when things get really interesting. You're going to raise anywhere between 50 to maybe $250 million for your Series C. You will most likely on that latter end, if you raise 150, 200 plus million dollars, you're a unicorn. You are now $1 billion company. You are focused on brand affinity, brand awareness, hiring the top executives. And in this round, you're bringing on not just growth investors, you're bringing on late stage investors. You're bringing on crossover funds, folks who actually buy and acquire companies or invest in public companies. Those people are now also trying to early front run your ability to become a publicly traded company. Okay, we have now reached the horizon. Series D and later. This is your pre-IPO stage. I'm talking Replit. I'm talking Anthropic, OpenAI, Cognition, Ramp. These are all companies that are going from being a startup to a corporation and realistically priming themselves to become a publicly traded company. They're focused on industry dominance. They're spending money. They're growing their workforce by 2, 3, 4x in 1 year. And they're literally not only trying to dominate their industry, they're trying to expand multiple industries and also continue to dominate. At this stage, as a founder, you're focused on risk. The company is no longer going to fail, it's going to be fine. You're focused on risk, and you're also focusing on profitability, growing at a strong rate, but profitably. Your boardroom looks like a IPO or public company style boardroom. You now have independent board members, people who aren't investors in the companies. You have industry experts who are now on the board. You're probably doing commercials, billboards. You're doing all these things. You might have a spokesperson for the company. You might have hired a celebrity to become a spokesperson at the company. Your job is growth, growth, and growth again. Okay, and for fundraise here, you're going to be raising well over $100 million. You might be raising hundreds of millions of dollars. Even some companies will raise billions of dollars in Series D or later. Typically in this round, you're going to have dilution of anywhere between like 5 and 15%. And this will probably be the same for Series C and Series B as well. These are companies that are very efficient, also growing at a very predictable rate, and they won't fail. Someone will either acquire them or they're going to IPO. So that's why the dilution is much lower in these later stage rounds. In terms of investors, you will have crossover funds, you might have private equity, you can even have sovereign wealth funds starting to invest in your company. You are now a vessel for the entire financial market of the global world to now find returns on investments. And here, the goal really here is to IPO or get acquired. After you have passed the Series D and Series E rounds, your goal is to enter the public markets or to be acquired by a large company. Okay, so why is this video important? This video is important because fundraising is just a black box. You really don't understand as a founder what is going on in the market, who's saying what is the signal from the noise. And so if you can just follow these guidelines every time you're fundraising, I think you can be in a really good position. And I'll even throw up a quick screenshot of Carta, who is a big industry expert with data on the typical dilution that you should be taking every round. And to realistically just share with you, by the end, if you're about to IPO or if you're about to get acquired, as a founder, you should have mid-teens ownership at the end or potentially single digits. It just depends on how much capital or how capital intensive your business has been.
They never saw the grind, yeah. Heard them talking down, put a price on my sound, let them watch me build.